Ever feel like everyone in the business world is obsessed with chasing unicorns?
Unicorns.
Yeah, not the mythical kind. Although, maybe the comparison is closer than you think.
Ah, I see.
I'm talking about those legendary, high-value investment opportunities that everyone's always trying to get a piece of.
Right.
So today we are diving deep, and trust me, the findings are going to surprise you into the economics of that hunt.
And we're going beyond, just picking those winners and losers, right?
Yeah.
This is about the relationship between the people who are making those investment decisions and then the people out there searching for that next big thing.
Absolutely. And to guide us, we're tapping into some really cutting-edge research from the Journal of Accounting and Economics.
Always a good source.
Right. But don't worry, we're going to skip all that academic jargon.
Yeah, please.
And just get straight to the core idea, which is actually pretty brilliant.
Okay.
They figured out a way to model the entire investment process, right? To reveal those sort of hidden forces that are at play.
Interesting.
And it doesn't matter if we're talking SPAC mergers or, even internal company innovation, this model applies.
Okay, so what's the secret sauce? What are they looking at?
Well, it all comes down to the relationship between two key players, and this is where the model gets really fascinating. The principal and the agent.
Okay.
Now, picture the principal as, let's say, company headquarters, the people holding the purse strings.
Right.
The agent is the one who's actually out there on the ground, kicking the tires, doing the deal making.
So the CEO, the VC partner.
Exactly.
Okay, got it. So classic power dynamic, but where's the twist?
Well, the twist is information, or to be more precise, the lack of it.
Ooh, juicy.
Right. So the agent, they're the ones seeing those potential unicorns up close and personal. The principal, on the other hand, they're stuck relying on the agent's reports.
So you've got this breeding ground for what economists love to call a dynamic agency problem.
Okay, so two-part question. What's the problem, and why is it so dynamic?
All right, so put yourself in the principal's shoes for a second. You're desperate for that unicorn. Right. But you're completely dependent on the agent to actually find it.
Okay, big time dependence there.
So how do you actually make sure that they're not holding out for something even better and you end up with absolutely nothing?
Right. You don't want to be stuck with a donkey while they're out there, riding high with a mane full of profits.
Precisely.
So how do you manage that risk?
Well, that is the million-dollar question this research is actually tackling.
Okay.
And they found it's not about just setting this rigid quality bar for the agent to meet, but actually crafting this dynamic incentive system that keeps everyone motivated.
A system, huh? Okay, lay it on me. What kind of system are we talking?
So they proposed 3 key elements.
Okay.
First, you got your resource budget. That's the war chest that you give to the agent to actually go unicorn hunting. But, and here's the catch, it's not unlimited.
Ah, so the clock is already ticking from day one.
Absolutely. There's a sense of urgency built in. Because just like in the real world, time equals money.
Yeah, makes sense. What's next?
All right, so next you have your investment threshold.
Okay.
Now that's the minimum quality level, right, that a potential investment needs to meet for the agent to even bring it back to the principal. But, and here's where it gets really interesting, this threshold, it isn't static.
Oh, okay.
It changes over time.
Oh, wait. A moving target. Why would the minimum standard change?
It's all about risk and reward.
Okay.
Remember, the principal, they don't want to wait around forever. So as time goes by, that resource budget, it starts to dwindle.
Right, and the clock keeps ticking.
Exactly.
Yeah.
And the closer they get to zero, the higher the risk for the principal that they're going to end up with nothing at all.
Ah, so it's a nail-biting scenario for them.
Absolutely.
Yeah.
So as that clock ticks away, the principal becomes much more willing to compromise. They'll accept a lower quality investment just to avoid being completely shut out.
It's like they're lowering the bar out of sheer desperation.
In a way, yes, exactly.
So it's that fear of missing out completely that trumps the desire for the perfect opportunity. Makes sense. But what about the agent in all of this? I mean, they're the ones doing the legwork, right?
That's right. And that brings us to our third crucial element of this incentive system.
Yeah.
The internal charge.
Internal charge, okay.
So the agent, they actually pay for the resources that they burn through during that search.
Interesting.
And just like that investment threshold, this cost, it's not fixed. It changes over time.
So the longer they search, the more expensive it gets for them, like a built-in penalty for indecision.
You got it. Now, the researchers dove deep into the mathematical weeds on this.
I bet they did.
They used some sophisticated math to figure out the optimal way to balance these 3 elements.
Right.
But the cool thing is, Even without getting lost in the equations, we can grasp this core concept. It's about managing these incentives in an environment that's full of uncertainty and where there's all this hidden information.
It's like a high-stakes chess game where you're constantly having to adapt to your opponent's moves, it seems like. Speaking of high stakes, I'm guessing all this pressure, it's got to have consequences, right?
Right.
So what are some of the unexpected outcomes that the research uncovered?
Well, one of the most surprising findings is that this whole setup, it often leads to overinvestment.
Overinvestment? Wait, that's not what I expected at all. Isn't the whole stereotype that companies are too cautious, too afraid to take risks?
Yeah, and it's a common misconception. What this research does, it highlights that this fear of missing out, it can be a much stronger motivator than the pursuit of, like, the absolute perfect opportunity.
Right.
Remember how the principal's quality bar, it keeps getting lower and lower as the search drags on?
They'd rather end up with a donkey than no unicorn at all.
In a way, yes. And here's the kicker. This isn't some irrational blunder. It's actually the most logical response to this very tricky situation.
Interesting.
They're balancing this potential payoff of finding a unicorn with this very real risk of ending up with absolutely nothing.
This is already blowing my mind. But I think this is a great place to pause for a second, digest what we've learned. When we come back, let's bring this down to earth a little bit. How does this play out in the real world? And what does it actually mean for all of us listening?
Welcome back. We've been talking about this idea of overinvestment and how things like fear of missing out can actually lead companies to settle for less than ideal investments just because they're afraid of being left behind.
Yeah, it really flips the script on some of those kind of common assumptions, you know? And this research, what I think is so cool about it, is that it actually connects these dynamics to real-world situations we see playing out every day.
Okay, so let's talk about those real-world situations. Give me some examples. Where do we see this tendency to overinvest rear its head?
All right, well, let's start with the recent SPAC boom.
Okay.
Right. SPACs.
So for our listeners who might not be familiar, SPAC stands for Special Purpose Acquisition Company. And basically, it's a shell company that goes public with the sole purpose of finding a private company to merge with.
Right, like a fast track to the stock market.
Exactly. But here's the thing. We've seen a lot of SPACs actually underperform after they merge with their targets.
They have, yeah.
And our little deep dive here, it actually gives us some clues about why that might be.
Okay.
Think about it, right? SPAC sponsors, the folks tasked with actually finding those target companies, they are under immense pressure to close a deal.
Yeah, they've got that ticking clock, right?
They do. They usually have like a 2-year window.
Right.
Or they have to return the money to investors.
It's that same dwindling resource budget we were talking about earlier, that pressure to make a move.
Exactly. And as that deadline gets closer, and the perfect unicorn is still out there somewhere, those sponsors, they might be more likely to settle for a less impressive target, even one that's not quite ready for prime time, just so they don't have to liquidate and give the money back.
Because nobody wants to admit defeat.
Nobody. And it all comes back to that FOMO, that fear of missing out, influencing those big decisions.
It's incredible, isn't it? How much our emotions play into these things.
Absolutely. But it's not just SPACs.
Right.
This dynamic, it pops up in mergers and acquisitions more broadly. Think about it. Companies, they're driven by this constant pressure to grow.
To expand,
to get into new markets, acquire new technologies. But all of that can lead them to jump into deals way too quickly, overpaying for targets that maybe aren't the best strategic fit down the line.
It's like they're so busy trying to win the deal that they forget to ask themselves if they actually want the prize.
100%, yeah.
Yeah.
They're focused on that short-term win. But what about the long game?
Right, exactly.
And then, of course, you've got venture capital. I mean, talk about a pressure cooker.
Oh, yeah.
VC firms, they're always on the hunt for that next big thing, and they're constantly competing with each other to get in on the ground floor.
Oh, yeah, they're cutthroat.
And all of that leads to these crazy bidding wars, these inflated valuations, especially for companies that, they show some early promise, but they haven't actually proven that they can deliver in the long run.
So even in those early stages where, the potential payoff is huge, but the risks are also significant, we're still seeing this tendency to overinvest.
Absolutely. It's a constant. But here's where it gets even more interesting.
Okay, you got my attention.
What happens when you add another layer of complexity to this whole thing? What happens when the agent isn't exactly playing by the rules?
Okay, this feels like we're moving beyond just fudging numbers on a spreadsheet.
We are. We're moving into moral hazard territory.
Woo, moral hazard.
So what if the agent, they have a chance to, shall we say, pocket some of those resources instead of using them to diligently hunt for that unicorn?
So instead of sticking to the mission, they might be tempted to, feather their own nest a little bit.
Exactly. And that throws a wrench into the whole thing because now the principal has to adjust their strategy. They can't keep an eye on every single thing the agent's doing, right? So often what happens is they end up having to lower that investment threshold even further to keep the agent engaged.
So wait, the fact that the agent might act in their own self-interest, it actually increases the chance that the principal will settle for a lower quality investment.
It seems counterintuitive.
It does.
But remember, the principal's working with limited information.
Right. They don't have the full picture.
Exactly. They have to balance the potential rewards with the risks. And that includes the risk that the agent might go rogue.
This is fascinating and a little unnerving. It makes you think, how often does this happen in the real world?
Right.
And at what level?
It's a question worth asking, absolutely. The key takeaway here is that investment decisions, they're never made in a vacuum. There's this whole web of incentives, information gaps, and strategic calculations.
It's a lot more complicated than it looks from the outside.
Absolutely.
So the next time we see some big company making, a splashy acquisition or even putting a ton of money into some internal project, maybe we shouldn't be so quick to judge.
I like that.
There's probably a lot more going on behind the scenes.
There always is.
Than any of us realize. It's this fear of missing out and these complex relationships between the people searching for the unicorns and the people actually holding the purse strings.
You said it. And understanding these forces, it can make us all better investors, more informed observers of the business world.
For sure.
And maybe even more thoughtful innovators ourselves.
I love that.
Because at the end of the day, it's about realizing there's always something more to uncover.
Always another layer to peel back.
Absolutely.
So before we took a break, you were just starting to tell us about how this whole overinvestment thing, it's not just about, companies going out and making deals. It can actually happen inside a company too, right?
Exactly.
Okay, so tell me more about that. What does this look like when it comes to a company's own internal operations?
Well, think about innovation, right? When a company's trying to develop something new, a new product, a new technology.
Right. So instead of looking for unicorns out in the wild, they're trying to, breed their own.
There you go. That's a great way to put it. And in this scenario, you can think of the chief technology officer, the CTO, as our agent.
Okay.
They're the ones championing the new ideas, pushing the boundaries.
Right. They're the ones leading the charge.
Exactly. And then, of course, you've got company leadership, the ones holding the purse strings. They're the principal.
Okay, makes sense.
So the CTO, they're under pressure to deliver that next big thing. But just like we've been talking about, they've got a limited budget. They've got that ticking clock.
And that pressure, I imagine, it can lead them to make decisions that maybe aren't in the company's best long-term interest.
That's exactly right. They might be more inclined to focus on those, safer bets.
The less risky projects.
Yep. The ones with a faster turnaround time, even if it means, potentially overlooking something truly game-changing that might take a bit longer to develop.
It's like that old saying, no one ever got fired for playing it safe. The thing is, if you only focus on the short term, you might miss out on those huge breakthroughs that could really change the game.
Absolutely.
Yeah.
And that's a really important point to keep in mind. This whole overinvestment thing, it's not necessarily about people making bad decisions.
Right.
It's about the system itself. It's those incentives, the way we measure success, the pressure to deliver results quickly. All of those things can push people, even really smart people, to make choices that might not be the most innovative or the most beneficial in the long run.
So if we're trying to make sense of all of this, if we're trying to understand why companies make the decisions they do, what's the most important thing to remember? What should we be asking ourselves?
Look beyond the surface.
Okay.
Don't just look at the investment itself, the deal that gets made, the product that gets launched.
Right.
Ask yourself, what's the motivation behind it? What information does the person making the call have? Or maybe more importantly, what information are they missing? Because those information gaps, they can make a huge difference.
They can really skew your perspective.
For sure. And then think about the incentives. What are they being rewarded for?
Because that's going to influence their decision making.
100%.
This has been such an eye-opening conversation. It really makes you think twice about everything you see happening in the business world.
I hope so. That's what we're here for.
Well, you've definitely given us a lot to think about. Thanks so much for joining us.
It was my pleasure. Always love a good deep dive.
And for our listeners, thanks for being here for another episode of The Deep Dive. We'll be back soon with more insights and analysis, but until then, stay curious.